Hello. Welcome to the Legal Aspects and Ethics in Banking course. Today we are going to learn about the first topic of this course, which is the relationship of banker and customer. Before we proceed, let me inform you about the learning outcomes of this topic. At the end of this topic, you should be able to define banking business and customer, identify the elements of contract between banker and customer, and explain the types of relationship between banker and customer. Now let us talk about subtopic 1.1, which is banker and customer. We will discuss briefly about the definition of banking business and customer, as well as the rights and duties of a banker and a customer. Bank is defined as someone who carries on banking business. According to the Financial Services Act 2013, banking business may refer to activities such as receiving deposit in any currency or deposit account, paying or collecting check, providing loans and advances, and any provisions allowed by the Ministry of Finance. This definition was emphasized in the case of United Dominion Trust Limited versus Kirkwood. On the other hand, customer has no statutory or legal definition. Common law gives the definition of customer as a person who has an account with the bank. This definition is widely used in the Malaysian banking system. Moreover, there are 5 legal cases that can be referred to in defining customer. In Woods versus Martin Banks, a customer is defined as a person who has been provided with bank services and has intention to open an account. In Ladbroke and Company versus Todd, a customer is someone who has submitted an application to open a bank account. In Great Western Railway versus London and Country Banking Company Limited, a person is a customer only if he has an account with the bank. In Oriental Bank versus Rubber Industry, a single transaction with the bank is enough to consider a person as the bank's customer. In Headley Byrne versus Heller, a person is a customer if he accepts bank's advice. These are the rights and duties of a banker. As a banker, you need to know what are your duties so you can perform them professionally, and at the same time, you also need to know your rights so you can make decisions wisely, especially when encountering with problems, especially problems related with your customers or clients. For instance, the case of Buckingham and Company versus London and Midland Bank emphasized the banker's right to set off or combine accounts. The case of Foley versus Hill highlighted the right of banker to use money as it wishes, while the case of London Joint Stock Bank versus Macmillan and Arthur stressed on the right to expect customer due care in issuing check. These are the rights and duties of a customer. Just like a banker, customers also need to know their duties so they can have smooth dealings with the bankers. They also need to know their rights so that they can deal with any dispute which may happen when dealing with a bank. For instance, the London Joint Stock Bank versus Macmillan and Arthur case stressed on the duty of customer to exercise reasonable care in drawing check, while in the case of Greenwood versus Martin Bank, emphasized the duty of customer to notify bank promptly if they notice any forgeries.
Let us move on to the next topic, which is topic 1.2, the relationship of banker and customer. In this subtopic, you will learn about the 5 types of relationship that a banker and a customer may have. Banker and customer may have a relationship based on contract. This is whereby the relationship between a banker and customer is limited to what have been stated in a contract. It is controlled by the general rules of contract, agency rules, general banking practices, and based on transactions. This relationship was emphasized in the case of Burnett versus Westminster Bank Limited. Moreover, bank may also become the constructive trustee of a customer, hence creating a trustee and beneficiary relationship. This relationship was highlighted on the case of Lloyds Bank versus Bundy and Carrick Rubber Company Limited versus Bundy and others. Next, banker and customer may also enter into a special relationship, such as the banker becomes the customer's financial advisor or broker. Apart from that, when customer borrows money from the bank, a debtor and creditor relationship is created. When giving out loan, the bank will use the money deposited by other customers. Hence, the other depositors become the creditor and the bank become the debtor. This relationship is highlighted in the case of Foley versus Hill. Finally, when a customer gives his banker any mandate or instruction to perform certain transactions such as buy or sell shares, a principal and agent relationship is created. This is whereby the bank acts as an agent.
Now, let us move on to the final subtopic, which is topic 1.3, the contract between banker and customer. There are several important aspects of the contract that we need to understand so that we as bankers or as customers will know our position or the action that we should take in any of our dealings. The first aspect is the limitation of action. The limit to start any legal action is 6 years. If plaintiff wait after 6 years to start a legal action, the plaintiff will lose the case because of statute barred. The case of Joachimson versus Swiss Bank Corporation emphasized that if an account is in credit balance, the account must be dormant and the first warning or demand letter must be issued 6 years ago to consider the legal action is statute barred. If the account is in debit balance, the legal action must be taken before the 6 years period starting from the last transaction of overdraft. Next, banks can set off any account, except loan account, at any time unless there is an express or implied agreement to the contrary. For loan account, banks must give a reasonable time to the customer before performing the set-off. This aspect was stressed on the case of Buckingham and Company versus London and Midland Bank. There are conditions that need to be fulfilled before set-off is performed, and there are accounts which cannot be set off such as private debt and trust credit account, deceased and executor account, customer credit account and contingent liability on bill discounted, and solicitor and visitor account.
Next, bankers must not tell others about the customer financial information even the account has been closed unless with customer consent. Banker can only disclose under compulsion of law, if required in the public interest to prevent fraud and crime, in interests of banks or if there is an express or implied consent of customer. Next, if debtors make no appropriation of payment, banks may make appropriation provided that debtor has the chance to do appropriation but fail to make it. If there is no specific appropriation between debtor and creditor, rule of Clayton can be applied. Next, standing order is an instruction made by customer to its bank to make regular periodic payments to a third party. There are 3 important practical considerations that need to be followed by banks such as bank incur no liability if it fails to obey order if customer's account is insufficient, must ignore any cancel payment order from a third party and should advise to contact customer directly if asked by a payee about payment. Moreover, banker's opinion refers to the report or opinion of bank related to the financial standing or credit worthiness of customers. Bank provides information about their customers to third party upon request and they must have customers' consent. There are practical considerations need to be followed by bank and when giving out banker's opinion, there are possible liabilities faced by banker toward its own customer or inquirer. Next, banks have duty to send monthly bank statement to its customers that shows debit and credit entries in the customer's account. The relationship between bankers and customer can be terminated in 3 ways. It may happen if both parties must agree to end the account. This is known as mutual agreement. It also may happen unilaterally, whereby termination made by bank or termination made by customer. Bank must give reasonable notice before closing customer account that has credit balance. The relationship can also end by operation of law. These include the case of customer liquidation, bankruptcy, death, mental incapacity, and garnishee order. There are 2 types of interference by third parties on bank and customer relationship. First is Mariva injunction. This is a court order preventing a defendant from transferring assets from the bank to other places until the outcome of the associated lawsuit is decided. It may be in general order to freeze all defendants' assets with a particular bank or maximum sum order. Next is garnishee order, which is a court order requested by judgment creditor whereby all funds or property belong to the judgment debtor which in the possession of a bank, must not be or are prohibited to be released until a direction or instruction as to their disposal is received from court.